So for the past, I don't know, 30 years or so, the global economy has kind of operated like this perfectly lubricated, completely frictionless machine.
Right, yeah. Capital moving anywhere, instantly.
Exactly. I mean, supply chains stretching thousands of miles just to find the absolute cheapest labor, and then consumer goods just endlessly flowing back in the other direction.
A total era of unfettered free trade.
Yeah, but recently, I mean, you can kind of hear the gears grinding, right? You can feel that
Oh,
friction.
absolutely. It's palpable.
Like, for everyone listening, have you ever noticed that a cheap charging cable you order online from overseas suddenly costs a little more? Or wondered why your grocery bill isn't shrinking, even though the news anchors are loudly broadcasting that global crude oil prices have
It's
plummeted?
because that friction, well, it's intentional.
Really?
Yeah. We are watching the architects of this global machine actively throwing sand into their own gears.
Mm.
We're unwinding that whole era of free trade and pivoting toward this incredibly defensive, highly fragmented, and protectionist model.
Which is wild. And today, we are pulling our map for this transition from a really wide-ranging, highly analytical interview. It's from the Dutch financial platform Holland Gold, featuring analyst Frank Knopers.
A fantastic, very dense discussion.
Extremely dense, and the ground they cover really maps out a transition to what they're calling a multipolar era. So an era dominated by, well, government intervention, the weaponization of trade, and pretty much a complete rewiring of how wealth's accumulated and preserved.
Yeah, it's a massive shift.
It is. Okay, let's unpack this. And the catalyst for unpacking this massive geopolitical shift actually starts with something as mundane as an iPhone cord.
Right, because the micro often reveals the macro.
Totally.
And just to set the stage here, the sources touch on some pretty intense political and economic debates. But our goal today is just to connect the dots. We're just exploring the underlying mechanics of these trends without taking any political sides.
Exactly. We're just looking at the machinery. So the source highlights this relatively new policy proposal within the European Union. It's a €3 import tariff specifically targeting packages under 150 euros coming from outside the EU bloc.
Which on a bureaucratic level, I mean, it just reads as a minor customs adjustment, right?
Right, but the rhetoric surrounding it was fascinating. When the EU announced this, the public messaging was heavily framed to suggest that the international businesses would absorb this €3 tariff. Like the consumer, theoretically, would be totally shielded.
Which is just pure fiction.
Pure fiction. The math on that does not work. A community note on social media actually pointed this out almost immediately. If a vendor in Shenzhen is selling a USB cable for €1, and they have these razor-thin margins, they cannot mathematically absorb a €3 tax penalty.
No, of course not. They'd be paying €2 just to sell you the cable.
Right. So the cost is instantly passed to the consumer, or the vendor just abandons the market entirely. I mean, the fundamental law of commerce dictates the end user pays the friction cost.
Always.
So why go after the tiny packages? What is the systemic threat of a cheap cable?
Well, the threat is volume. And the
Okay.
volume is just staggering. I mean, the EU currently processes roughly 6 billion of these sub-150 euro packages annually.
6 billion.
Yeah. And the critical data point the source flags is that 90% of those packages originate in China.
Wow.
So that is 5.4 billion individual shipments flooding the European market every single year.
That isn't just organic consumer demand, though. I mean, that is the downstream result of a decades-long state-sponsored economic strategy.
Precisely. Since China joined the World Trade Organization in the early 2000s, Beijing has just meticulously engineered an export-driven growth model.
Right.
And they achieve this through hyper-industrialization, massive domestic subsidies, and crucially, currency manipulation.
The undervalued yuan?
Exactly. The People's Bank of China would routinely hoard U.S. treasuries to keep the yuan artificially undervalued. And that ensured their manufacturing base operated at a price point Western domestic producers could just never rival.
They couldn't even come close.
No, they subsidized the capital costs of their factories so deeply that the primary objective wasn't necessarily even profit. It was global market share and just keeping their own massive population employed.
And we are seeing the physical manifestation of that strategy just tearing through European industry right now. I mean, the source points out that Volkswagen is currently staring down the barrel of up to 100,000 potential job cuts.
It's unbelievable.
It's tragic. We are looking at the possibility of entire manufacturing ecosystems in Germany just hollowing out
Yeah.
because the symbiotic relationship where Germany sold high-end machine tools and luxury cars to a developing China, that has completely inverted.
Right, China climbed the value chain.
They climbed it, they utilized those tools, and now they're flooding the European market with their own advanced manufacturing, especially in the EV sector.
Which completely reframes that €3 package tariff. I
Yeah.
mean, it is a defensive maneuver. It's an
Yeah.
attempt to just cauterize the wound in the local retail and light manufacturing sectors. But what's fascinating here is the geopolitical whiplash.
Oh, the hypocrisy is
Mhm.
off the charts.
Yeah, the European policy establishment spent the late 2010s publicly decrying the Trump administration's aggressive tariff policies.
Yeah, they branded those actions as an assault on the liberal world order, like the catastrophic end of free trade.
Exactly. Yet, you look at the current European policy slate today. Tariffs on microshipments, stringent quotas on imported steel,
Yep.
the whole carbon border adjustment mechanism, which is effectively just a green tariff,
Right.
and now a baseline 10% tariff layered onto Chinese electric vehicles.
I mean, the vocabulary is draped in diplomatic regulatory language, but the mechanical action is identical to the populist protectionism they were criticizing literally a few years ago.
Because it signals a definitive end to that late 20th century consensus. Capital and goods are no longer permitted to flow strictly based on market efficiency. We are reverting to this state of political economy where governments are actively stepping in to protect their industries.
And the irony is that state intervention often creates the very crises it later has to solve with more intervention.
Oh, absolutely.
Like, take the European automotive sector. The EU mandated some of the strictest internal combustion engine regulations on the planet, pushing these super aggressive timelines for complete phase-outs. And to force compliance, they pumped massive subsidies into the consumer market to, spur EV adoption.
But the legacy European automakers, they were institutionally slow to pivot their supply chains.
Right, they weren't ready for batteries.
No, they weren't ready to capture the demand their own governments had engineered.
So those European taxpayer subsidies effectively functioned as a massive stimulus package for Tesla and Chinese firms like BYD. The EU regulated their domestic champions into a corner, subsidized the market demand, and just handed the profit margins to their primary geopolitical rivals. It's crazy.
That really is.
And now, to artificially resuscitate the European auto industry that they handicapped, they have to abandon half a century of free trade dogma and erect tariff walls.
Right. And to understand the philosophical weight of what we're witnessing, the source material draws this brilliant historical parallel.
I love this part.
Yeah. This debate we are having right now, this clash of efficiency versus autonomy, it is a direct echo of an ideological clash from the 19th century.
So for decades, the bulk of our lifetimes, the West has operated under the framework pioneered by Adam Smith, the core of classical economics.
Right, the invisible hand.
The division of labor, free markets, producing goods wherever it's cheapest. The governing logic is that if it requires fewer resources to manufacture a solar panel in Xinjiang than in Bavaria, well, the market should optimize for that efficiency.
Because global wealth increases, consumer prices fall, and capital is deployed to its highest use. And, I mean, it's an elegant theory that demonstrably pulled hundreds of millions of people out of poverty. But the source contrasts Smith with this 19th century German economist, Friedrich List.
And List argued that Smith's model contained a fatal flaw, right?
Yeah. List said Smith treated the global economy as this food marketplace of individuals, completely ignoring the role of the state. List believed that nations must protect their own industries to build autonomy.
Because blindly adhering to free trade might give you cheap consumer goods, but it inevitably strips a nation of its domestic industrial capacity.
Right, and surrendering industrial capacity is synonymous with surrendering national sovereignty. If you can't forge your own steel or refine your own fuel or today manufacture your own microchips.
Your geopolitical independence is an illusion.
Exactly. And List pointed back to Napoleon's continental system as the prime example of this dynamic.
Right. In 1806, Napoleon issued the Berlin Decree, effectively blockading British goods from the European continent.
And while the immediate goal there was to financially starve the British Empire, List observed this massive secondary effect. It acted as an extreme, forced incubator for French and European domestic industry.
Because they were deprived of cheap British textiles, so they had to build their own factories.
Yes. List argued that developing nations must actively shield their nascent industries with tariff walls, even at the cost of short-term inflation and consumer pain, because the long-term strategic cost of dependency is just existential.
And we are living in a Friedrich List world again.
We really are.
The pursuit of cheap goods has completely taken a backseat to the pursuit of national security and supply chain resilience. And the source actually cites this recent International Monetary Fund report that maps out that we have officially entered a fourth historical wave of state intervention and nationalization.
Yeah, that IMF report is crucial. It outlines this historical pattern where state consolidation of private industry moves in cyclical waves, almost always triggered by acute systemic stress.
Okay, so walk us through the waves.
So wave one was post-Great Depression. States intervened to halt total deflationary collapse.
Right.
Wave two was post-World War II rebuilding. The physical capital of Europe and Asia was pulverized. Only the sovereign state had the balance sheet to finance the reconstruction of heavy industry and energy grids.
That makes sense.
Then wave three hits in the 1970s. The Nixon shock severs the dollar from gold, the Arab oil embargo sends energy prices to the moon, and governments violently intervene to secure domestic energy flows, giving rise to massive state-owned national oil companies.
Because crisis demands centralization.
Exactly. Which brings us to wave four, the one unfolding right now. And the targets of nationalization have evolved.
They're not seizing automotive plants anymore.
No, they're taking aggressive stakes in utilities, strategic minerals like lithium and uranium, funneling massive capital into weapons manufacturing.
To replenish what's been sent to Ukraine.
Right, and most critically, intervening directly in the development of AI.
Because AI is the ultimate strategic high ground. The state views sovereign compute capacity the exact same way they viewed nuclear stockpiles during the Cold War.
Oh, without a doubt.
I mean, look at the massive export controls the U.S. has placed on NVIDIA's most advanced chips. They are cutting off entire sovereign states like China and parts of the Middle East from the underlying hardware of the AI revolution.
And economist Russell Napier actually labels this entire paradigm national capitalism.
National capitalism.
Yeah. The idea that the free market is no longer trusted. Governments dictate the economy based on strategy and national security, not price discovery.
But the source material surfaces a really deeply concerning secondary effect of the centralization. When the state expands its mandate to actively manage the macroeconomy, that architecture of control invariably bleeds down into the micromanagement of the citizenry.
It does. The transition from economic protectionism to behavioral surveillance is historically a very short leap.
And just a quick neutrality reminder for everyone listening. We are exploring the concerns raised in the source material regarding civil liberties here. We're mapping the policy, not taking a political stance.
Right. The source material scrutinizes a suite of initiatives currently moving through the European legislative pipeline that reflect an aggressive expansion of digital monitoring.
Like the push for digital IDs.
Yes, digital passports to log onto the internet, age verification requirements mandating you prove you're 15 or 16 just to access social media.
And the legislative branding is always framed around security or protecting minors or combating disinformation.
But the architectural reality is the systemic eradication of digital anonymity.
Yeah. And the apex of this shift, according to the source, is the proposed digital euro, the central bank digital currency, or CBDC.
Right. And economist Daniel Lacalle is quoted in the source describing CBDCs as surveillance disguised as money.
Which is a heavy phrase. But to understand why that isn't just hyperbole, we really have to look at the mechanical difference between a physical euro and a digital euro.
Exactly. When you hold a physical 20-euro note, you hold a bearer asset. The transaction clears the moment you hand it to the merchant. There's no intermediary, no counterparty risk, and no metadata generated.
It's private.
Totally private. But a CBDC operates on a permissioned unified ledger controlled directly by the state's central bank. It transforms money from a neutral bearer asset into a programmable utility.
And programmability is the mechanism of control. Because if the central bank has real-time visibility into every transaction, they possess the technical capacity to implement behavioral economics at the protocol level.
Yes, the underlying concern is that a digital currency could eventually be used to track or restrict purchasing behavior.
Like if a regulatory body determines your carbon footprint exceeded a monthly quota, the ledger could theoretically decline your transaction at the gas pump.
Or if inflation is running too hot, they could program a negative interest rate directly into your wallet. essentially putting an expiration date on your currency to force you to spend it.
Wow. Your purchasing power literally becomes contingent on your compliance with the current political orthodoxy.
And the source correlates this economic tightening with a parallel tightening in the information space, pointing to some deeply concerning precedents regarding censorship.
Oh, this part was jarring. The anecdote about the German court ruling?
Yes. So the application of European sanctions against the state-funded Russian media outlet Russia Today, it provides a chilling case study. The sanctions initially targeted traditional broadcasting infrastructure, which is, standard wartime geopolitical maneuver.
Yeah.
But the interpretation of that law metastasized. German courts ruled that even private citizens running obscure hobbyist websites could be penalized simply for embedding freely available YouTube videos of Russia Today broadcasts.
That is absurd. The legal rationale was that by embedding the public video, the individual was acting as an unlicensed broadcaster of sanctioned material.
Exactly. It establishes a standard of secondary liability that fundamentally breaks the mechanics of an open internet. And it contrasts so sharply with the EU's public branding as this beacon of a free press.
It reveals this profound institutional insecurity. Like, the state must pre-filter the information environment because the citizen cannot be trusted to independently evaluate a hyperlink.
Right.
And that paternalistic instinct, the assumption that the state knows best, it manifests in incredibly mundane, almost comical ways, too.
Oh, the Harlem example.
Yes.
Right.
To provide a relatable, slightly absurd example, the source highlights a zoning ordinance from the municipality of Haarlem in the Netherlands. In a newly developed neighborhood, the local government unilaterally banned the opening of any snack bars.
They banned snack bars.
They banned snack bars, and they didn't just stop at commercial zoning. They legally prohibited the act of consuming fries on the street within that specific district.
It's the micro-application of the macro philosophy.
It sounds like a dystopian parody. So what does this all mean? Is this just clumsy bureaucracy, or is it a deeper philosophical shift?
The source argues it's a profound philosophical shift. There are two distinct mindsets at play here. One believes in individual freedom and responsibility. It accepts that free people will make suboptimal choices. They'll eat unhealthy food, read terrible media, make bad investments. But preserving that agency is worth the friction.
Right.
The other mindset, which the source says is currently dominant across Western bureaucracies, believes citizens aren't smart enough to care for themselves. They need the state to guide their behavior.
But that leads to a vicious cycle, because those technocratic solutions often create worse economic or social bottlenecks.
Exactly.
Which brings us to the actual balance sheets of everyday people. Because this creeping friction, this constant state intervention, is exerting massive gravitational pressure on wealth. The source pulls data from the recent UBS Global Wealth Report, and the trends are alarming.
They really are. When you look at the aggregate numbers, Europe is still historically very wealthy. The legacy wealth is immense. But when you isolate the trend lines over the last 5 years, the divergence is brutal.
Break down the numbers for us.
So in Western Europe, the median wealth, which is what the average person actually holds, is actively declining. The net worth of the statistical middle-class individual is shrinking, while extreme wealth inequality is rising. The ultra-rich are getting much richer.
Right.
But conversely, when you look at emerging markets in Eastern Europe, both overall aggregate wealth and median household wealth are growing simultaneously.
It's a tale of two Europes. And the analogy I like to use to explain this is, think of Western Europe's economic status like a colossal generational trust fund.
That's a good way to look at it.
Right. If you start with a massive inheritance built during centuries of Adam Smith's free trade, you can afford to make bad investments for a long time before you go broke. You can fund massive bureaucracies, mandate 35-hour work weeks, absorb heavy regulatory burdens, and live very comfortably.
While the principle of that trust fund slowly bleeds out.
Exactly. But for a 25-year-old starting from zero today, trying to build wealth purely from the value of their labor, it's incredibly hard. The friction is suffocating.
And the source links that friction directly to the tax environment. To fund this interventionist state, we are looking at jurisdictions where marginal tax rates, when you combine income tax, social premiums, municipal levies, they can hit nearly 80% on extra income in some middle-class brackets.
80% on the next dollar earned.
Yeah. The incentive to innovate, scale a small business, or just take an extra shift is mathematically destroyed.
But the most destructive mechanism highlighted is the approach to wealth taxation, specifically referencing the Dutch Box 3 system.
Box 3.
Because this isn't a traditional capital gains tax where you pay a percentage of your profit when you sell an asset. Box 3 essentially taxes an assumed return on your assets.
It functions as a tax on unrealized gains.
Which is wild.
It is. If you're a middle-class saver who invested in a diversified portfolio, the state assumes a fixed percentage of growth and taxes you on that assumption. Even in years where the market is flat or actively crashing, you are still liable for the tax on the phantom gain.
So it forces everyday savers to liquidate their actual assets just to pay the tax bill on the assumed gains. It's literally state-mandated destruction of compound interest. Social mobility is stalling out completely.
Meanwhile, the ultra-rich use international corporate structures to bypass these rules entirely. The localized, small business owners and regular savers are the ones footing the bill for the expanding state.
It's a systemic squeeze. And the systemic squeeze forces us to look at how these macro policies distort everyday markets. So let's talk about the energy paradox, because this is a question burning in every listener's mind.
Oh, absolutely.
If you track the commodities markets, global crude oil prices have experienced a massive drop. The source notes crude dropping from roughly $100 a barrel down to the $70 range. That's a huge deflationary move.
It is.
Yet, if you drive to a gas station, the price of gasoline and diesel at the pump is still agonizingly high. The math doesn't map. Where is the disconnect?
The disconnect is a massive lack of refining capacity. That's the bottleneck. The global supply of raw crude oil is fine, but you can't put crude oil directly into your car engine. It has to be cracked and distilled into usable products like diesel and gasoline.
Right.
And we are operating with a structural deficit in refineries.
Because of the policy interventions we were just talking about, right?
Exactly. Throughout the 2010s, the dominant narrative driven by Western governments and ESG mandates was that fossil fuels were stranded assets. The green transition was happening immediately.
So the major oil companies were basically told their product would be obsolete in 10 years.
Right. So why would an energy major spend $10 billion in 10 years to build a massive new refinery complex if the regulatory state is signaling that the end product will be outlawed before it even breaks even?
They wouldn't. They just stopped building them.
They stop building. And then you layer acute geopolitical events onto that structural underinvestment. Like the source points out, the Ukrainian drone strikes on deep inland Russian oil refineries. You take millions of barrels of daily distillation capacity offline in a market that already had zero slack.
And the result is the refiners who are left have absolute pricing power.
Exactly. The margin that companies make to turn raw crude into diesel, the crack spread, is at record highs.
Which actually creates a really interesting investment implication.
It does. The source points out that because energy stocks, like Shell for example, often trade based on algorithmic models tied to the spot price of crude oil.
The algorithms see crude drop from 100 to 70, and they automatically sell the stock.
Right, completely ignoring the massive refining profits these companies are making from the bottleneck. So there is a current value opportunity for investors in the energy sector who understand that physical constraint.
That makes total sense. But what about the broader market? Where should a listener put their savings right now?
Well, the source outlines that the market is basically violently torn between two competing fears. The debasement trade and the deflation trade.
Okay, break those down for us.
The debasement trade is the fear of inflation and relentless money printing. Investors realize that to fund all these nationalizations and sovereign debts, central banks have to print currency. This leads people to hunt for scarce assets, driving them to buy gold and Bitcoin.
Right, fleeing fiat.
Exactly. The counterweight is the deflation trade. This is the fear of a severe recession, or that the massive AI and tech bubbles are going to burst.
So in that scenario, people run back to the perceived safety of government bonds or those monopolistic regular tech stocks.
Exactly. But here's the dynamic that forces everyone's hand. The math of negative real yields.
This was my aha moment regarding the stock market boom. Like, why are stocks hitting record highs if the economy feels so shaky?
The math explains it perfectly. Let's say true inflation is running at 6%, and your safe savings account pays 2%.
Leaving the money in the bank guarantees a 4% loss of purchasing power every year.
Right. It forces everyday savers to dump their money out on the risk curve into the stock market just to tread water.
Because of this massive influx of forced cash, traditional valuation metrics are totally distorted. High price-to-earnings ratios, like a PE of 30, might not be a bubble anymore. It might just be the new normal in a system where the currency is perpetually melting.
It's the liquidity-driven baseline.
So if fiat is melting, what are the central banks doing? Because they are the apex predators of the financial system.
They are hoarding bullion at historic speeds. The source notes that global central banks bought another 41 tons of physical gold in a single recent month.
Okay, let me push back on that for a second. Because historically, the textbook model says when interest rates are high, gold prices drop. Gold doesn't pay a yield, so when bonds are paying 5%, people sell gold and buy debt. With all these rate hikes, why is gold staying near all-time highs?
Well, if we connect this to the bigger picture, the model actually broke in early 2022. Gold completely decoupled from interest rates.
Because of the Russian sanctions.
Exactly. When the Western Alliance used the SWIFT system to instantly freeze roughly $300 billion in Russian central bank reserves, they proved that sovereign reserves held in dollars aren't assets. They're unsecured liabilities.
Dependent on the geopolitical goodwill of the U.S.
Right. And every central bank in the multipolar world realized simultaneously that if they get on the wrong side of the West, their treasury can be zeroed out with a keystroke.
So the drive for gold is now purely geopolitical fear. Countries and individuals want an asset entirely outside the dollar system, immune to sanctions. A non-counterparty asset.
Precisely. And that inherently leads to the digital equivalent of a non-counterparty asset, Bitcoin.
Right. But the source flags a very specific localized risk in Bitcoin right now.
They do. While the long-term view on Bitcoin as sovereign internet money remains positive, there is a massive short to medium-term risk centering around Michael Saylor and his company, MicroStrategy.
So MicroStrategy holds roughly 850,000 Bitcoin, which is just an insane concentration. But the vulnerability isn't just the size of the holding, it's how they got it, right?
Right. He financed this by issuing high-yield corporate debt, some tranches carrying up to 10 or 12% interest.
Wow.
So as long as Bitcoin goes up, this debt-fueled strategy looks like absolute genius.
But Bitcoin recently dropped 40% from its peak.
Exactly. And that's the danger. If Bitcoin's price drops significantly below his average purchase price, he is trapped paying massive double-digit interest on an appreciating asset.
And if the core software business can't service that debt?
The creditors will force a liquidation. He'd face a catastrophic margin call. And if MicroStrategy is forced to sell hundreds of thousands of Bitcoin to cover its obligations, it could cause a cascading crash in the entire crypto market.
Retail panic sells, DeFi protocols liquidate. It would be brutal.
It's a massive concentration of corporate leverage hanging over the market.
Wow. Okay, we have mapped out a really heavy, complex architecture today. From the death of free trade and Adam Smith's model to this new Friedrich List era of protectionism. We've looked at the realities of inflation, the energy bottleneck, and the creeping government control via CBDCs and wealth taxes.
It's a sobering map.
It is.
Yeah.
Thank you for sticking with us through this, by the way. But the source material does provide a final optimistic thought, doesn't it? A ray of hope.
It does. And the antidote to all this bureaucratic sclerosis is demographic, generational shifts.
The younger generation's BS detector.
Exactly. The current system is bogged down by 20th century ideology and overregulation. But the next generation, they have grown up immersed in the failures of these interventions. They see through the inefficiencies. They are the ones who will clean up the mess and build a new, parallel, more pragmatic system.
They'll build the decentralized networks and localized supply chains to replace the broken machine. That is exactly the signal we're looking for in the noise. So I want to leave you with a final, provocative thought to ponder this week. If we truly are entering an era where governments prioritize national security and control over free markets and cheap goods, how does that change the way you value your own skills, your investments, and your privacy? Are you preparing for a world of Adam Smith or a world of Friedrich List?
That's the question that will dictate wealth for the next 20 years.
It really is. Thank you for joining us on this deep dive. Stay curious, question the friction, and we will see you on the next one.